Good evening, everyone. I'm Larry Kudlow. Welcome back to Kudlow Company. We aim to be right on America, right on business, and right on the money. And we still believe that free market capitalism is the best path to prosperity. On this evening's program, the roaring stock market continues to discount the Goldilocks economy. It is still the greatest story never told. My newest wrinkle is that Goldie may be entering into a new period of deflationary growth with lower interest rates and lower energy prices. So, joining me now to discuss is Joe Lavorgna, Chief U.S. Economist at Deutsche Bank, Michael Darda, Head Economist at MKM Partners, Craig Columbus, Chief Market Strategist at Advanced Equities Asset Management, and, as I live and breathe, Doug Kass, President of Seabreeze Partners Management. We are going to begin with an amazing quotation from Michael Darda, something that will live on forever. Put it up on the board, folks. Inflation surrender. All right, while we are not yet convinced that the inflation dragon has been slain, we at least have the verisimilitude that core inflation pressures are moderating significantly and that the inflation threat is behind us. Michael Darda, very nice. First of all, verisimilitude. What does that mean?
Well, that's a key word, Larry. It means the appearance, because I'm afraid that's all we have at this point. Yes, core inflation over the last several months has come in below consensus. I'm still much more worried about a second core inflationary push next year, so I'm not making the argument that this threat is totally gone, but the data is what it is, and the Fed is on hold, and liquidity and growth-sensitive asset classes are melting up, so I think the recession call is looking weaker and weaker. In the inflation call, I know my side's not winning it now, and it was just an acknowledgement of that.
Well, we like an honest man. We like an acknowledgement. Joe Lavorgna, you especially like an acknowledgement. I think it's very brave of Michael Darda and very honest, Joe, that he said what he said. But I want to ask you, we're going to put a chart on the board. The Consumer Price Index is now, for the month of October, where it fell by 0.5%. The CPI is 4.3% at an annual rate below the level of the third quarter. No, that is not the right chart. CPI chart, it should show a negative. That's the 3-month change, and it is coming down. I want to get the right chart up here because this is going to be so important. If the CPI is 4% below the third quarter level, I hope we get this chart up, it tells me, Joe, the GDP deflator is going to be negative for Q4. So if you're right and you get a low 2 or 3% money GDP number, Joe, the declining inflation is going to push up real GDP. I call it deflationary growth. What's your take?
I don't think so, Larry. I think the GDP numbers are going to be quite soft this quarter, and the nominal numbers will be soft in part because of the deflator. How do you get around the slump,
Joe? We've never had a 4% drop in the CPI.
I think only
that's what it's showing. That's going to change the whole calculation.
But here's the thing, though, Larry. I think, don't quote me on this, but I think we've only had one negative nominal number in GDP where we have, or excuse me, the deflator negative in a quarter. It has happened very, very few times. I think the problem, Larry, is this. If you have weak nominal GDP, you're going to have weak corporate profits. And weak nominal GDP implies that the Fed funds rate has to come down a lot. And I think that is what's helping equities. The fact that the 10-year yield is below 460, valuations look attractive, and the stock market, just like the bond market and that yield curve inversion, senses Fed cuts. And that's why all these markets are so happy.
I think you're right. I think Fed rate cuts are entirely appropriate. The curve is inverted. We have another picture. I hope we do better on this one. The monetary base has been flatlined for the last 10 months. I call it Milton Friedman money. That's what Milton talked about before he passed away and what he wrote about. I think the oil prices sets up a deflation. Let me go to Craig Columbus. Craig, I see deflationary growth. This is a kind of off-the-chart forecast, but I believe the deflator is going to be negative in Q4, and as weak as money GDP may be, it's going to produce positive real GDP and actually will help the quality of earnings because of falling oil prices. There's the chart. We finally got it up. CPI, 1 quarter change. Look at this carefully. 2.2 in Q1. 5% peak in Q2 that got the inflationists all excited. Then it drops down to whatever that is, 2.9 in Q3. And look at this. For the month of October, we are minus 4.3%. That is almost unprecedented. Craig Columbus, I say the Goldilocks stock market sees it and understands it and is looking for rate cuts. What's your take?
Well, you're not the only only one that sees. I mean, the credit spreads are tight, Larry. I mean, the junk bond yield, that's as low as it's been, I think, since September of 05. Now, Mr. Poole from the St. Louis Fed was out this week with that language about symmetrical, saying that now the odds of a rate cut are roughly equal to the rate increase.
That's a big change, by the way.
Absolutely.
At the margin, that's a huge change in Fed policy.
Everybody we talked to was really looking at that, Larry, saying now we'll probably get the tightening bias language out in December. So you picked up on it, too.